Ethereum's second-time delays. Sharding developers are exhausted, investors are angry, and gas keeps rising. That sentence alone carries years of frustration, broken expectations, and quiet denial. You hear it and think this is just another delay, another roadmap tweak, another technical excuse. But if you slow down and look closer, something more unsettling appears. Ethereum is not just postponing an upgrade. It is revealing the limits of a promise that millions already priced in as reality. Ethereum was sold as a living system, a blockchain that would scale with the world, a base layer for everything: finance, apps, identity, games, governance. You were told that congestion was temporary, that high gas was a short phase, that Sharding would arrive and make all of this cheap, fast, and accessible. Not eventually. Soon. And then soon became later. Later became after the merge. After the merge became after rollups. And now Sharding moves again, quietly pushed further down the road. From the outside, it looks like normal software development. Complex system takes time. Security matters. Better safe than sorry. That explanation sounds reasonable until you realize something uncomfortable. Ethereum has been live for years. Billions of dollars have flowed through it. Entire economies depend on it. And yet the core scaling solution keeps slipping like a mirage you never quite reach. Developers feel it first. The people actually building on Ethereum are not reading roadmaps. They are paying gas. They are watching users drop off because a simple action costs more than the value being moved. They optimize. They rewrite. They migrate to layer 2 networks. They accept complexity because they have no choice. And over time, fatigue sets in. Not dramatic burnout. Something quieter. The slow realization that the base layer is no longer designed for them. Investors feel it differently. They were told Ethereum would become ultrasound money. Deflationary. Efficient. Dominant. They watched the merge happen and expected the rest to follow quickly. When Sharding moves again, they do not see a technical adjustment. They see time risk. Every delay is another window for competitors. Another excuse for users to leave. Another reason narratives start to crack. And then there is gas. Gas is the lie detector. Gas does not care about vision or philosophy. Gas reflects demand colliding with limits. And gas keeps rising. Not always in a straight line, but enough to remind everyone that the fundamental constraint has not disappeared. It has only been outsourced. This is where the story turns uncomfortable. Ethereum did not fail to scale. It chose a different kind of scaling. Instead of fixing the base layer first, it pushed activity outward. Rollups. Layer 2 networks. Side systems that promise cheap transactions while settling on Ethereum. On paper, this looks elegant. In practice, it changes the meaning of Ethereum itself. You no longer use Ethereum. You orbit it. To do anything affordable, you bridge assets. You trust sequencers. You rely on new assumptions. You accept withdrawal delays. You hope the stack holds together. The base layer becomes a settlement court you rarely visit because it is too expensive to enter. And suddenly the promise has shifted without being openly acknowledged. Ethereum becomes less a global computer and more a high-end security layer for systems most users never directly touch. Sharding was supposed to fix this. Data availability. Sharding would massively increase capacity and lower costs across the ecosystem. That was the story. But every time it moves, you have to ask why. Is it because it is hard? Or is it because the system already adapted in a different direction? The truth is not flattering. Ethereum scaling now depends on rollups succeeding. Sharding is no longer the hero. It is the supporting character. The base layer is optimized for rollups, not for users. And that means gas fees staying high is not a bug. It is a signal. High gas tells you the base layer is intentionally scarce. Scarcity creates value. Value protects security. Security attracts capital. Capital rewards holders. This is great if you are positioned correctly. It is awful if you believed Ethereum was meant to be cheap for everyone. This is where the quiet anger comes from. Not rage. Not panic. A slow, grinding resentment that the original vision slipped while nobody formally admitted it. Developers feel trapped. Investors feel misled. Users feel priced out. And the roadmap keeps moving just far enough ahead to maintain hope without delivering relief. When Ethereum delays Sharding again, it is not just a technical delay. It is another moment where the community is asked to accept that the system they rely on is not optimized for them anymore. You can see it in how conversations change. No one asks when gas will be cheap. They ask which layer 2 to use. No one expects simple onboarding. They accept bridges and wrappers and abstractions. Complexity becomes normal. Confusion becomes part of the cost. And here is the part that leaves a bad taste. The narrative never fully updates. Ethereum still presents itself as the foundation of decentralized finance, as the neutral layer for the world. But in practice, access to that foundation is gated by cost and complexity. The people who can afford it are whales, institutions, and infrastructure players. Everyone else rents access through layers built on top. So when Sharding moves again and gas keeps rising, the frustration is not just about fees. It is about honesty, about whether the system you committed to is still aiming for the thing you believed in. This does not mean Ethereum is doomed. Far from it. Ethereum may succeed spectacularly at what it is becoming. A highly secure settlement layer for a web of roll-ups. A financial backbone rather than a public square. But that is a different promise than the one many people bought into. And that is why this delay hurts more than previous ones. Because at some point, delays stop feeling temporary and start feeling structural. At some point, you realize the waiting itself is part of the design. The base layer stays expensive. The ecosystem adapts around it. And Sharding becomes less a solution and more a symbol of what might have been. So Ethereum delays Sharding again. Developers are tired. Investors are angry. Gas keeps rising. And the real question is no longer when Sharding arrives. The real question is whether Ethereum still wants to be the thing Sharding was meant to save.